Hello and welcome to Portfolio Matters Week 87 Weekly Update. And what a week it has been. Thankfully, Richard is back, but before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research and consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Before we get going, a few pieces of housekeeping. First of all, thank you very much to everyone who turned up for our drinks on Wednesday night. It was great to meet a few new people and some old faces. So it's been an extraordinary week in the UK, and this weekly will be concentrating on the UK. So we are not going to do Recession Watch or the EU Energy Crisis Watch. Instead, next week, I'm actually going to be away. I'm flying to Chicago to do the marathon, actually, later in the week. So I will put out a short weekly on Wednesday with that data. And now let's get on with it. Okay, first of all, news. So somebody has blown up Nord Stream 1, and we suspect it's the Russians, showing that they can disrupt European pipelines if they so choose. But that certainly cuts off any hope of more gas from Russia this winter. We had revised US GDP figures, which confirmed that the US economy shrank during the first half of the year, and the market took that badly. Germany has announced a 200 billion euro energy subsidy bill, and German inflation shot up in September. It rose from 8.8% in August to 10% in September. That means the ECB is going to have to raise rates. And then the elephant in the room, the UK. Well, so last Friday, while we're on air, Kwasi Kwarteng unleashed his unorthodox fiscal policy on the world, on an unprepared world, which took it really badly. So sterling fell very sharply, although it's now almost completely recovered as of today. And there was a huge rise in gilt yields, which created chaos and potential solvency problems for UK pension funds, which we will go into, and forced the Bank of England to intervene to calm markets. And the Bank of England is doing essentially £65 billion worth of QE to calm markets. So this is Nord Stream 1, and the dotted line is Nord Stream 2. And there were 3 explosions detected by the Swedes and coinciding with these enormous leaks. And these leaks are hundreds of meters across, showing vast volumes. The FT this morning was estimating 300,000 tons of methane leaking out. And why have they done this? Well, it's possible that the Russians are sending a message about all these pipelines that connect Europe, particularly Norwegian gas fields, with the rest of Europe, and essentially saying these are vulnerable. I can't think of anyone else who would be incentivized to blow up the pipelines.
No. And also, they're virtually indefensible.
Yeah.
Because they could pick any point, if they wish to, they could pick any point to plant a bomb.
Yeah.
Or to make it a subsea vehicle.
Now, turning to the extraordinary events in the UK, well, this is the gilts market, the price of the 30-year UK gilt. And you can see it was collapsing after the mini budget, fell over 20% until the Bank of England intervened. And the Bank of England has succeeded in almost entirely reversing that fall in the 30-year. We will show you gilt yields, shorter term gilts, and those the yields have moved permanently higher. Now, there were particular problems in the index-linked gilt market. We will go through all this in some depth later, but you'll see that on Wednesday, before the Bank of England intervened, the price had fallen very sharply to just over 40, and then by the end of the day, it had risen to 92. So anyone who had bought at the bottom would have more than doubled their money by the close of the afternoon. Absolutely extraordinary moves in UK gilts. Okay, on to this week's economic data. And we had a load of PMI numbers. So in Europe, the PMIs were pretty much unchanged in September from August. Take a look. In the UK, they were again pretty similar. PMIs showing that both the EU and UK economies are in slight contraction, but are not really deteriorating as fast as we might expect. But then the energy crisis really starts to kick in October. Now, in the US, we had pending home sales, which fell, missing expectations. So the expectation was they would contract by 23% year on year. In fact, they fell by 24%. We then had US PMIs, and they were again quite resilient. So manufacturing PMI was expected at 52. It came in just a touch below that, 51.8, indicating US manufacturing was still expanding. The services was expecting at 47. It came in at 49.2, i.e. only a slight contraction. The composite was at 49.3. The other data we had was Chinese industrial profits, and they contracted year on year by 2.1%. So further evidence that China is not doing well. Now, we also had some quarterly numbers. Now, the big quarterly number was US GDP, and these are the final figures. The final figures confirmed that US GDP fell in both the first 2 quarters of the year. So that is a technical recession, although it has not yet been called a recession. We also had PCE inflation. Remember, that is the Fed's preferred measure of inflation. And I'm afraid that was not reassuring. It was expected to be at 7.1%. It came in at 7.3%. So once more, there is no evidence of slowing inflation, and there is nothing to stop the Fed continuing to raise rates. Core PCE inflation also beat expectations by a good margin. It was expected at 4.4%. It came in at 4.7%. Now, in the UK, we had quarter-on-quarter GDP growth for Q2, and actually that was okay. Came in at a very subdued plus 0.2%, but it was expected to be negative. So the UK is proving more resilient than expected. Year on year, the economy grew at 4.4% when it is expected at 2.9. Some charts, Richard.
Thank you, Keith. I should just say, well, I actually tested positive for COVID this morning. So if I sound a bit hoarse and break off to cough from time to time, that's the reason. The PMIs for the EU, continuing their downward trend, as Keith said, just below 50, which is contractionary now. And the services PMI in the EU doing the same thing in slightly contractionary territory. And the composite one, as you would expect, also contractionary with a steady downtrend since around March, April time. But not huge as yet.
Yeah, none of them are contracting at quite the rate I would expect given consumer confidence.
Yeah. I mean, yeah, exactly. And the economic sentiment indicator in the EU isn't looking very healthy. It's on a rapidly descending downward course. And there we have EU consumer confidence plummeting the depths.
You see, given the record low reading in consumer confidence, I would have expected the other data to be similarly negative, but actually is much stronger than you might expect.
It may be that we see that coming through in subsequent months.
Yeah.
And the UK manufacturing PMI is still below 50, a little bit of a tick up there. Obviously, the recent events, far too soon to have an impact on any of these numbers. And the services PMI still dropping steadily towards 50. It hasn't really moved below 50, apart from COVID and the aftermath of COVID, since 2008.
Yeah, but it is now below 50.
Yeah. And the composite PMI for the UK looking on a steady downtrend. So US PCE inflation moving upwards. So it has these little ticks down, but basically it is continuing its uptrend at the moment. No sign of a change in that. And the core inflation seems to have sort of reached a little peak at 6.
It's not coming down as expected.
US GDP growth, very slightly negative, as Keith says, totally anemic economy really the last half year. And durable goods orders month on month showing a slight decline and slight negative level. And the US manufacturing PMI still above 50, and although it's fallen substantially, it's still in positive territory. And the services PMI coming back up towards 50, so moving out of a slight contractionary time. And then the composite basically is being is following with the services PMI, the biggest mover. The US house price index is starting to turn down, which I think we've been predicting it would do for a while. In fact, the downturn is quite large, but it's still a long way to go before house prices are no longer rising year on year. And the month-on-month indicator has moved into negative, i.e. house prices are falling now for the first month in a long time.
Yes, I should add that we've been meaning to do an update on the used housing market for a few weeks now, but there's been so much going on, haven't had a chance. I will aim to do that next week.
Yeah. And the US 30-year mortgage rate continuing to go up fairly rapidly. Bearing in mind, a lot of house purchases in the US are made on 30-year fixed rate mortgages. And so obviously once one is fixed, one's fixed. So this is more applicable to people who are coming new to the market or require a new mortgage rather than existing mortgage holders.
Yeah, but mortgage rates in the US have more than doubled in the past year.
Yeah, and they're back up to where they were 15 to 17 years ago. US pending home sales plummeting. That year-on-year contraction is really significant. And initial jobless claims are actually continuing to look reasonably healthy. US continuing jobless claims looking healthy. So September PMIs depict the EU, UK, and US economies. Little change from August. We've got a little bit deterioration in the EU and the UK, but resilience in the US. However, US house sales are falling, which is classically the housing market in the US, as Keith has pointed out on many occasions, is a leading indicator of economic stress in the US. And in the US, the inflation is persistent, and therefore the Fed is likely to persist with its rate rises.
Now, last week, I had a comment from Richard B on the YouTube chat saying that it was all doom and gloom and could we have something to cheer us up? Well, Richard's back, thankfully. And so hopefully we'll have more of a bit of banter this week. But in the meantime, I've instigated the weekly funny because frankly, it is again doom and gloom. And if anything, last week I wasn't quite doomy enough given the week we actually had. So anyway, enjoy. Okay, so we are going to skip Inflation Watch and all the other watches and get straight into the UK situation. Now, the mini budget was all about creating economic growth and boosting the UK's economic growth to 2.5% a year. Now, how do you create economic growth? Well, if we turn to the Solo growth model, formula there, economic growth is a function of capital, labor, and productivity, i.e., how efficiently you use product, labor, and capital.
Keith, can I just interject here?
Yep.
We know that energy is a hugely important input into modern economy. In fact, all economies, and basically economic growth over the last thousands of years has corresponded to an increase in energy consumption. But this model doesn't include energy consumption.
You're absolutely right, Richard. And energy and materials are a given. So this model assumes a lot. It assumes that you can get as much energy as you require. And all models, I should say, make huge assumptions, as Richard has just pointed out. So to create growth, you can increase the amount of labor you're using, i.e. total hours worked by the whole economy, increase the amount of machinery you are using, i.e. capital and buildings and that support workers, or use the two more effectively, and that is productivity, and that is a function of technology. So going through those, labor, well, the big gains in GDP were from moving workers off low productivity work in the fields and farming into the industrial workforce. And in the UK, that was achieved in the 19th century, whereas in China, that has been achieved in the last 20 years and is one of the drivers of China's extraordinary GDP growth over the last 20 years. We then have moving women out of the house into the labor force. And in the UK, that was largely achieved in the 50s and 60s due to social changes. But also, we shouldn't underestimate the impact of the widespread use of domestic appliances, such as the dishwasher, the washing machine, etc., which meant you could do a lot of household labor with much fewer hours. And then finally, there's immigration. But Brexit was an explicit attempt to limit immigration. Or you can get existing workers to work longer. Now, sickness was a big reason why a lot of workers couldn't work as long as they would like to. But the revolution in medicine over the last 100 years has massively improved the welfare of workers. And although that revolution continues, the gains are much more marginal now. Although we have had a huge setback by COVID. We'll show you some data. Now, the mini budget did address hours worked to a minor extent by changing tax incentives. So it cut income tax from 20p to 19p, and at the top end from 45p to 40p. But the assumption there is that highly paid workers will work longer because their marginal tax rate has been cut, and that is a very questionable assumption.
I think the issue with tax, to my mind, Keith, is that the UK is moving into being a very high tax economy, and in my view, high tax economies are inefficient. The government is very bad at allocating capital efficiently. It tends to waste a lot of the tax revenue it receives on non-productive activities. And of course, tax take comes from all sorts of sources, VAT being a huge tax take, national insurance. And cutting employment taxes by a small amount doesn't really address the overall issue of this country being, in my view, having a far too high a tax environment. One of the things that really bugged me with Rishi Sunak was when he said he couldn't reduce taxes because it would be inflationary, which I believe to be complete nonsense. So the issue we've got is that we have everything you've said is correct, but we also have a system where government is much too dominant in the activities of the economy.
Well, I take your point, Richard, but the reality is in this country, we like strong social safety nets and services, and we have an aging population, and we have guaranteed to that aging population both healthcare and pensions. And over the coming years, those bills will only get larger. Now, when you talk about Rishi Sunak's comment that he couldn't cut taxes because it would be inflationary, well, frankly, I see his point, because the fiscal bills deficit due to pensions and the NHS will only continue to grow. And if you don't continue to raise taxes, then that is inflationary.
Yeah, we're getting into a political debate here, Keith, which we should try and minimise. But of course, the problem with pensions is the triple lock currently, which David Cameron put on, however many years ago, which was remarkably foolish.
Yes, I completely agree with you. We're on an unsustainable path. So this is a share of UK citizens more than 16 years old who are looking for work. And you'll see that actually COVID has caused a big drop due to a rise in long-term disability. So this is the claimant count, and you'll see that it's shot up, and there are a lot more people on universal credit. Now, this budget does nothing to address that and to try and get those people back into work. And if we look at the reasons why people are economically inactive, you see there's been a huge rise in long-term sickness due to COVID. And all that adds up to lots of job vacancies and nobody to fill them. And one of the explicit aims of Brexit was to stop European workers to come and work and fill these jobs. Okay, so moving on to capital. Well, UK investment is very poor by international standards. And what incentivizes investment? Well, you want low taxes, so high corporate profits, which you incentivize to invest. But also you want to have a stable monetary, regulatory and fiscal environment, so you know that your long-term investment will reap predictable rewards. And hasn't gone well this week. And you want low interest rates, so it is cheap to invest. Oh dear, interest rates were shot up this week. So the budget has been a spectacular own goal on investments as far as I can see.
So I just want to pick up on interest rates, Keith. I've already said this before, but when I first started working in finance, the first company that I worked with, which is a care company, very capital intensive, we had debt where the interest rates were between 13 and 15%. Now, it isn't the absolute level of interest rates. And that was 25 years ago. Interest rates have just dropped ever since then. This is not the absolute rate of interest rates. It's one, it's the rate of change, and two, it's a relative to your international competition, which I know you know. But the issue that we have had, I believe, is that we have had interest rates globally that don't reflect the true rate of inflation that the global economy has seen, because they haven't reflected the rates of inflation in asset prices. And that causes now investment anyway. And then obviously we have had this huge problem of late where the interest rates have had to shoot up dramatically in order to try and stabilize the currency. My point is, I don't think it matters if interest rates are 5 or 6%, as long as they are stable and representative of sort of an international norm and the interest rate necessary for appropriate allocation of capital.
Yeah, they're all good points, Richard. But I would also add that a lot of investment historically has been to implement new technologies. So if you think about, let's say, the invention of the jet, you have to build huge factories, airports, etc., so that you can use the new technology. And right now, we are only having very marginal new technologies. So we've got the internet, etc., which is driving some investment in broadband, etc., but we haven't had any real transformative technologies in a while. And I'll go on to that now. Just continuing to look at capital investment, the UK, according to the World Bank, has capital investment of 17.4% of GDP, and that is very poor by international standards. And business investment has stalled post-Brexit. So the blue line is business investment, and the green line is gross fixed capital formation. So post-Brexit, business investment is lower than it was pre-Brexit. And if we look at our capital investment relative to the rest of the world, well, it's really poor. It's lower than Italy, Germany, or the Eurozone. World Bank didn't have numbers for the US. So finally, on to productivity. Well, productivity is a function of new technology. And I'm going to recommend a fantastic book here, The Rise and Fall of American Growth by Robert C. Gordon. It is about 700 pages of dense economics, but it is a fantastic book which shows how the world economy was transformed by technology and how during the 18th and 19th centuries, when people only had lighting by candles, which were hugely expensive, then you could really only work for a few hours a day, the days of daylight during winter period. It goes through the transformation of society by such things as the move to first trams and then cars. Now, to give you just one example, when Chicago only had horse-drawn vehicles, they had to move many hundreds of tons of manure every day, horse corpses, and there was associated disease, and the size of the city was restricted to about 3-mile radius. Then when you had cars and trams come in, the whole city can expand, people move faster, etc., etc. And the point of that book is that we don't have any transformative new technologies coming in that will really change people's lives in the way we have done over the last 100 years. And he is pessimistic about economic growth going forward. And if we think about the transformative technologies that are arriving now, well, it's electric vehicles and electrification. And actually, you could argue that those will reduce productivity rather than increase it. We have to put more capital in to achieve the same result as a petrol vehicle. Richard.
So, Keith, it's very interesting. Transformative technologies are impossible to predict. One of the fundamental problems that we have is I think that government assumes that there will be a particular rate of growth, and it continues to increase social expenditure, clearly at faster than the rate of growth. So the tax take of the government is continually struggling to keep up with their electoral promises and the cost of running the social system of the state. And that is as evidenced by the fiscal deficits that we have and that this country have been accumulating for many years. There are two elements on that. We may or may not have a transformative technological change. In some senses, it's hard to see what it might be. I know there's quite a lot of poverty around, clearly, and you want people who live in poverty to live in less poverty, but many people are quite comfortable living in their houses. They've got their, as you say, their dishwashers and so forth. We have mechanized many things that previously were done by hard labor. So I would suspect the next transformative technology might be space exploration. But my point being that we're in a situation where governments desperately need growth because they have overcommitted themselves to these social programs. And if they hadn't done that and they didn't do that, we wouldn't be where we are now.
I completely agree with you, Richard. That's absolutely true. We don't really need growth. What we need is a better distribution of wealth so that more people feel they're better off. But actually going back to technology, just considering the transport sector and let's say international transatlantic travel. So in the 15th century, it was really dangerous and it took you 6 months.
Yeah.
We then had sail, cut it down to a couple of weeks. We then had steam, cut it down to a week. We then had coal, we cut it down to, less than a week. We then had planes, jets. Now it's down to 5 hours. Now, let's say that you had invented a teleporter tomorrow. It would save you 5 hours, but it's a marginal increase. The big change was actually from sail to the jet, and all that's been done in the last 100 years.
And that's an interesting concept, Reece. Keith, an interesting thought experiment. Another thought experiment that I've done is, let's say we have nuclear fusion and we have an infinite amount of energy that society can spend. Energy is virtually free. What would you do with it? What would I do if I didn't have any electricity bills? I might think I would spend the money on something else. But how would my consumption pattern change? I'm not sure that it would, particularly. It's difficult to know, isn't it? So the question is, are we moving into a state where actually we don't particularly need technological advancement in our society? Are we moving somewhere where we actually, as you say, rightly say, we need better distribution of wealth and well-being? I was always very struck when Gordon Brown used to give his budget speeches. He was constantly talking about growth, 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 the mantra of growth. And the question is, well, growth for what? What is the purpose of growth for its own sake? And I think as societies, we need to have a debate on what it is that we want to spend our money on, and move it away from the sort of politically correct debate of what we feel other people want us to say, and actually have a discussion about where our values lie and what we should be trying to achieve.
Well,
this is a bit existential, but
yes, well, I see your point, Richard, but I think that's beyond the scope of this economics and markets podcast.
Coughing away. Yes, I agree, Keith.
So this is UK productivity growth, and it's collapsed since the great financial crisis, and I'm not sure anyone's got a pretty convincing explanation as to why, frankly. So in summary, the mini budget had a stated aim that it was going to boost UK growth to 2.5% per annum. But actually, that's not really a serious goal. It did very little to achieve that. And it's very unclear as to how it would achieve it. We look at Labour, its marginal tax cuts were very unlikely to boost workers' incentives to make them work longer hours. Investment has been actively discouraged by the rise in interest rates and, more importantly, the regulatory and interest rate uncertainty, and productivity is just beyond the government's control. So it's not going to work.
So this is a section on sinking ships, I believe, UK mini budgets. This is the front cover of The Economist. It looks a bit sad, doesn't it? So well, it wasn't today's statement, but it was a statement from Quartet last week, represented the biggest tax cut since 1972. You can see the size of it there, and the long-term annual impact of tax policy announcements at each fiscal event. It is enormous in aggregate, and the key features of it were basic rate of income tax cut to 19% from 20% for next tax year. The high rate of 45% cut to 40%. The highest earners, the 19% corporation tax stays at its current level because Rishi Sunak had proposed to increase it. The proposed rise in national insurance will be reversed to 1.25%, which is a tax on employment, and which I'm actually heartily in agreement with removing it. 1.25% won't go ahead, and home buyers' stamp duty will start and kick in at £250,000 as opposed to £125,000. And as an aside, stamp duty is a ghastly tax because it basically gums up the property market and should never be introduced, never mind increased by various chancellors who we don't need to name because we all know who they are.
Completely agree.
Public borrowing. So basically in the March budget, we have the dark blue, and you can see that public borrowing was slowly dropping down, projected to, although stabilizing at around about 40 billion or so from 2024 onwards. And the new budget has said that public borrowing is going to be vastly larger than that. And of course, what does that mean? It means that the risk associated with purchasing UK government debt goes up very significantly. And that requires the effect of which is two things: either the currency falls or the interest rate goes up. The gilts market immediately sold off, i.e. interest rates immediately went up to reflect that increase in risk. And the currency fell as well. This is a table which shows the impact of the tax savings. And the unfortunate thing about this is that if you are earning £20,000 a year, which is in modern Britain not very much money, you are £220 a year better off as a consequence. So if you earn £200,000 a year, you are £3,500 better off. And these tax cuts are iniquitous, there's no doubt about it. And had they wished to really address the issue, they would have left the high rate taxes unchanged and spent the money on lower rate tax, in my view. And that just shows that graphically.
Yes.
So, there we have it. Almost 2/3 of the personal tax cuts will go to the richest fifth of the household. And Keith and I were talking about the need to redistribute and look after poor members of society, and this budget simply fails to do that. And I don't think it boosts growth. I don't think someone who sees their tax rate drop from 45% to 40% is going to go out whoopee and boost growth.
Absolutely, because the richest members of society have a very low marginal propensity to spend because they've pretty much got all their stuff. So you give them more money, they're more likely to save it. Yeah,
I completely agree, Keith. So the Chancellor's fiscal statement is predicted by the Resolution Foundation to permanently increase the budget deficit by £45 billion an annum, right, which is an awful lot of money. I think it is something like 6 or 7% of UK GDP. Freezing tax thresholds, i.e. the point at which your rate of income tax goes up, otherwise known as fiscal drag, means that we're actually not better off at all. The issue, of course, that they have is the 150 billion odd subsidy for energy. And as we've discussed before, if your energy cost to the economy is going to go up by, I'm going to pick a number here, £100 billion a year, either that comes through as price increases, i.e. inflation, or the government subsidizes it and has to increase taxation, in which case it comes through as inflation. And whilst I don't deny that you can't have families who can't afford it or households who can't afford it, paying vastly increased energy bills. The deceit that is being propagated here is that the government subsidy somehow solves the problem. It doesn't. It just shifts it somewhere else.
But also the way they've designed the energy subsidy bill, is the way not to do it. So they've put in a price cap and then taken on the liability for all the increase in gas prices above that. So they've got an open-ended liability. It would have been much more sensible to give everyone a one-off payment, and then people with larger houses, etc., should just turn down the heating. Or
they can make their own decisions thereafter,
yes,
can't they? But effectively what
exactly.
we're doing is saying we'll subsidize you whatever your consumption. So
precisely.
if you're a cannabis farm, as we saw in that earlier photograph, then your cannabis, your lighting is subsidized. Without further changes, only those earning £155,000 a year or more will be better off from the mini budget in 3 years' time, which is just extraordinary. And I think we will talk a little bit more about this, but the whole thing has just been incredibly badly thought through, or hasn't been thought through at all. It's utterly bizarre.
Yeah, so when it was pointed out that fiscal drag would actually mean that most workers were worse off in 3 or 4 years' time because of this budget, then over last weekend, Kwarteng then promised to further tax cuts to boost the incomes of these people, middle earners, and that caused a further sell-off in sterling.
Even without the energy price guarantee, the fiscal deficit is forecast to rise substantially over the coming years. So this chart shows so debt interest, which is the dark blue, which is the one we should really be looking at, is actually unrealistically forecast to reduce, I would suggest. But the projection is that what we are doing, what we are projected to do now is fiscally unsustainable. As it says on the sidebar at the right, we have the proposal is that we cut our income and, in fact, don't reduce our expenditure even without the subsidy for energy.
Yes, when you talk about the debt interest rate, Richard, this from the Resolution Foundation was earlier in the week before it had the big rise in gilts.
Yeah.
And essentially the government has lost the trust of the markets, and which has led to a permanent rise in interest rates, which will mean that the debt interest doesn't fall as this chart suggests. So you're perfectly right.
We're sort of in a debt trap, aren't we now? We're not far off being in it. I'm not sure we're in it yet, but the danger is we end up in one. So the cost of the energy price guarantee depends on market gas prices, as you would expect. But as we have previously discussed, it's £150 billion in debt in the coming years. And as we noted at the top, Germany has just approved a €200 billion subsidy for energy consumption. And Germany's fiscal position is far, far better than the UK's, although the EU's fiscal position in aggregate isn't. So we're in very difficult times. So our borrowing is expected to be 400 billion higher. 400 billion, was that 50% of GDP?
No, it's not, but it's I think it's about 25% actually.
It's just enormous amount of money. And I come back to this point that for decades economists have considered energy to be a free good.
Yeah.
And it isn't. It never was. Their models have never included energy prices, energy consumption. It's a huge fallacy that has come and caught an awful lot of people by surprise. So
this chart shows the effect of the budget on government finances, and the left-hand chart shows the fiscal deficit, the annual fiscal deficit. You'll see that in March, it was forecast that the fiscal deficit would fall rapidly from its pandemic highs towards 1% in 25-26. And now after the budget, It's going to rise because of the energy subsidies, and then it's not going to come anywhere near as far down as previously. It's going to remain towards 3.5%. And then if we look at the effect on the net debt, which is the right-hand chart, you'll see instead of declining, as it was forecast to do after Rishi Sunak's budget, it's now forecast to continue rising towards 100% of GDP.
So according to the Resolution Foundation, this is the largest permanent fiscal loosening on record. And we have low growth, as we have discussed, and a rising debt burden, as we have just discussed. And in comparative terms, we don't look good. And as we also discussed earlier, in the US, most mortgages are fixed over the life of the mortgage. In the UK, that isn't the case. Most fixed in the maybe 3, 5, occasionally 7 years. Very rare to have longer term fixed rates in the UK. So most mortgage holders are exposed to interest rates in the UK to some extent. The duration that they're exposed to them, the period is variable. But that means that the UK property market is very exposed to changes in interest rates. Our mortgage is 50% variable, 50% short-term fixed. And this is quite an interesting graph. We have to sort of stop and have a look to see how other countries compare with us. So a lot of homeowners will face enormous interest rate rises, and those who weren't fixed would have been paying maybe 2% a couple of months ago, 3 months ago, and now paying, what is the current rate, Keith? About 5%.
Yeah, we've actually got a section coming up on that, Richard. I mean, I've looked this morning and there still are deals about 5.2%, but the forecasts are that mortgage rates will go above 6% by next March. Now, this chart actually provides a wealth of detail. So this is the number of mortgages reaching the end of their fixed rate period, quarter by quarter over the next 2 years. And you'll see that if we look at Q1 2023, we have around 350,000 mortgages coming to their end of their fixed rate period. And the majority of those were fixed previously at under 2%. The remainder were fixed at between 2 and 2.5%. And when they refinance, they're going to be on 5. So the interest portion of their mortgage is going to more than double.
And that is on top of the increase in energy bills. So basically, disposable income is going to be squeezed even harder.
Yeah.
And this comes back to my point, actually, that his tax cuts only take tax burden back to the 2021 level. Now, obviously, the pandemic resulted in a huge amount of unplanned government expenditure. But the concept that, and this is where I sort of basically dispute Sunak's concept of reducing taxes would increase inflation, in that actually he would have been reducing them back down to what they were a short time before. And I think he was being disingenuous when he said that. But this is very interesting, isn't it? That we are in a real fiscal mess. And the tax share of the economy rise to its highest level since the 1940s. I'm not going to bang the drum again, but people now know my views on the tax rate.
Yeah. But the thing is, Richard, we do like good quality social services, and we've got an aging population. You know,
yeah.
Liz Truss says she takes the hard decisions. Well, she hasn't. She's taken the easy decision of spending more money. The hard decision would be to tackle entitlements, and she hasn't done that at all.
Very true, Keith. I mean, I think that's the nub of it, isn't it? Because tackling entitlements is an electoral threat.
Precisely. So
the summary is that the mini budget, this is without the energy subsidy, will add around 45 billion or 1.5% to the deficit. It is regressionary in that the major beneficiaries of it are the highest earning, and the smallest beneficiaries are the lowest earning people. It's unfunded. In other words, it hasn't been matched with expenditure cuts. And it mainly unwinds impending tax rises. So all the forecasts have to be rejigged, and the tax burden is still very high by historic standards. Was it really that radical, is the question. And I think that raises an interesting question about how far ahead financial markets really look, because these problems are here, and they were here before this mini budget, and they're still here now. And it's more a question of how we address the problem as opposed to making the problem go away.
Yes. Well, I think essentially what he did was he crystallized a lot of doubt in people's minds about the long-term sustainability of UK economic policy.
I think that's very true, Keith. Very true indeed.
Okay, so what are my thoughts on the mini budget? Well, it won't stimulate long-term growth in any serious way, and it frankly wasn't a serious attempt to do so. When Liz Truss said she makes difficult decisions, she doesn't. This was the easiest possible thing to do, just give money away. It didn't tackle entitlements or government spending. And it raises the fiscal deficit at a time of record low unemployment. So when she talks about stimulating growth, I mean, who's going to do the extra jobs? It just does. It's not intellectually coherent, this mini budget. It's also regressionary, and so it will give most money to the richest people. And I think she is out of tune with the popular mood on that. But above all, the announcement was very badly handled with no concern for the market impact. And it resulted in a loss of confidence in the UK's fiscal direction, leading to a rise in gilt yields, which is going to directly impact borrowers, homeowners in particular, who will see a large and immediate rise in their interest costs before they get a small increase in their take-home pay because of the tax cuts in April. So big immediate rise in their interest costs versus small rise in the income later. I mean, the electoral calculation behind this budget has been frankly disastrous. And the chaos of the last week in financial markets has put a serious dent in this country's reputation for good governance and fiscal prudence. But above all, to me, it breaks the social contract. So governments, what we've seen over the last 20 years is essentially both parties come in, they make a few tweaks, but they don't do anything radical. And that's really important because we have a highly financialized economy with a lot of debt. And what you want is low volatility, because high volatility in financial markets causes big winners and losers. And what we've seen instead this week is big changes in gilt yields and interest rates. And with the levels of debt, that is going to cause a lot of stress throughout the economy. And we don't yet know the full impact of that. Now, the Bank of England has had to intervene, but it's suppressing bond yields for now. At some stage, it's printing money to do that. There will be other side effects. So one word summary for me, incompetent.
Thank you, Keith. So my opinion, I'm afraid, is 2 pages long. I agree with everything that Keith has said. I have sort of taken a little bit of an overview. So how did we get here? So in my view, this crisis has been building for 20 to 30 years. We've got a number of contributing factors. So governments think they can manage their economies as one-dimensional processes. They're thinking about economies as simplistic in the extreme. They're highly complex systems with emergent properties and are inherently unpredictable. We've got central banks who've connived in reinforcing the view that the economy can be controlled and that it's a binary process. And we have fiscal deficits that have boosted growth and been funded by excessive debt and latterly by QE. Courtesy of the central banks required to correct, latterly by QE. And deficits can only continue for so long. And once tipping point is reached in recession, is required to correct over-indebtedness. And this has not been allowed to happen. It's basically been sat upon by central banks and governments.
So can I just interrupt you there, Richard? So what you're saying is we need a recession and then some borrowers to go bust to reduce overall indebtedness.
Yeah, absolutely. And return to the natural business cycle.
Yeah.
It's the canard of Gordon Brown, isn't it? I have done away with boom and bust. Well, actually, boom and bust is part of the normal business cycle. And excuse me, whilst one wants to try and manage the process so it's not too disastrous by managing it so it doesn't happen, all what happens is you move to where you end up in the position which we are now in, which is an enormous boom. And you just have to look at the chart of housing prices, asset prices generally, and where we're heading now, my fear is an enormous bust. So high levels of taxation lead to misallocation of resources, which is bad for the economy. We have high levels of taxation. Energy dependence, poorly understood. All the imbalances have been able to build up, and they now need to be rectified and have come to head simultaneously with the energy price spike, which has proved to be a catalyst. And these high rates of interest will kill the UK economy, but drive us into a deep recession. In my view, the EU and the US is not far behind. However, the US is the reserve currency of the world, which gives it far more options than we have. And on page 2, apologies for this, the solution. Well, we're so far down the rabbit hole of economic mismanagement, it's hard to see a way out for the West, other than ultimately currency reset. And I don't quite know how that works. Maybe it's a new Plaza Accord, but something has to change. It's obvious we can't dig ourselves, the UK can't dig ourselves out of this hole on our own. Truss and Kwarteng think they can fix the problem by reducing taxation and a bit of deregulation, which might have started to turn the ship 20 years ago, but it won't work now. Inflated energy prices have to come out either through currency debasement or subsidized energy, which is inflationary, or through direct inflation. Either way, it's inflationary. You can't avoid it. We have, because of what's just happened, become the leaders in a currency implosion. I believe it's going to happen in the euro. But I don't think we really wanted to be the first ones. I think it's better to be second in these things, not to lead the way, frankly. And the management of the process has been extraordinarily poor. And I think every time we talk about it, you think, what were these people thinking in the manner in which they did the process they went through, the manner they went through it, the lack of communication, the sort of grotesque degree of arrogance that they have showed in ignoring everything. And there isn't a solution to these problems, I believe, because I think we have gone too far. And I do think we need to have some currency resets. And I don't think we can get out of it by cutting taxes. We can't get out of it by increasing taxes. We can't get out of it by trying to increase productivity. We can't get out of where we are now. It's too difficult. And my view has always been, since we started in Portfolio Matters, that there will be a final round of QE. And I think it is just beginning.
Cheery stuff.
No.
So I don't know if any of you caught the local radio interviews with Liz Truss, but she didn't do very well.
I didn't hear them, but I heard that she basically had a series of answers that she had, and she wasn't capable of answering any question that didn't fit in the category of prepared answer. Yeah,
absolutely. Now, this is an interesting chart from the FT today. So essentially, they regularly survey political scientists around the world who give their rating on all the political parties. And you'll see that They have just shifted the UK Conservatives to essentially the most economically far right government in the world, political party in the world. I think they're completely out of tune with the rest of the country, and the opinion polls suggest they are. So Labour now have an absolutely enormous lead. Okay, now on to the action in the UK gilts market this week. Well, it was an amazingly volatile week. This is the UK 30-year. You can see that the price fell by over 20% and then rallied hard after the Bank of England intervened. And that was echoed around the world. So this is actually US Treasuries. And the pattern in US Treasuries is very similar to the one in gilts. So the ructions in the gilts market started with the mini budget. Kwasi Kwarteng's speech led to an immediate reaction in the UK gilts market. And now gilt yields have repriced higher. So UK interest rates are higher, remain higher a week later than they were pre-budget. And if history is any guide, whenever there has been a big fiscal loosening in the budget, interest rates have risen sharply afterwards. So there's been a lot of talk about the Barber budget in 1972, and interest rates rose hard after that. Now, the current budget is even looser than that, and so we should expect interest rates to rise sharply, and the market is expecting interest rates to now rise above 5% in the UK. And this is the 2-year, and it's now above 2%, having risen by over 1%. So this is the 2-year over the course of the last year. It started the year at under 1%. As of this morning, it's at 4.4. And it's risen over 1% over the course of the last week. But the big ructions were actually in the index-linked gilts market. So this is a long-dated UK index-linked gilt. And after the budget, it fell from 120 to just above 40. And then when the Bank of England intervened, it rose intraday, doubling to 92. What was going on? Okay, so the ructions in the bond market have been caused by a doom loop in UK pensions liability-driven investment schemes. So what are they? So pension funds know their future liabilities with a great deal of certainty. They know how many members they've got, how old they are, and when they're going to retire. And so the job of a pension fund is to attempt to match their assets with those future liabilities. And those liabilities will be a mixture of fixed and inflation linked. And knowing what the inflation rate is and yields are, you can calculate how many assets you need to match those future liabilities. So in the past, what pension funds would do is they would simply hold gilts and low risk assets to meet those future liabilities. So in this example, if you have 4% interest rate and £100 liability in 20 years' time, you need to hold £31 worth of 4% gilts to have £100 in 20 years. And that's what pension funds do. But over the course of the last 20 years, of course, yields have completely collapsed. And actually, so this is the yield on index-linked gilts. So index-linked gilts were now yielding the best part of -3% real. And so what that meant was that pension fund managers would have to put up enormous amounts of assets now to meet their liabilities in the future. And they found better ways of doing it to minimize their current liabilities. So how much assets they need to put up right now. In essence, what they did was, instead of holding £31 worth of assets, what they did was they held £31 worth of cash and entered a swap, making that equal to holding £31 worth of bonds. So they now have a derivative that gives them the value of the return on the bonds while retaining £31 worth of cash, which they then invested. So they have gearing, they've got leverage. And that allowed them to invest that £31 in equities and other stuff, giving a high return and also the return on the bonds. Now, technical point here, and we won't go into this into any great depth. There's a great article by Matt Levine in Sound Money on Bloomberg, which explains this properly. So pension funds are full of gilts, and you therefore would think that they are long gilts, and as gilt prices rise, they do well. But actually, it's the other way round. So they're in effect short gilts, because as gilt yields fall and gilt prices rise, the value of their liabilities increases faster than the value of their assets. So despite them having lots of gilts, they actually want gilt yields to rise and the value of their assets to fall, because that minimizes their liabilities. So because they're short gilts, effectively, in order to match assets with liabilities, they need to gear up so that they're no longer short. So all that worked really well as long as yields were falling. When yields fell, so the swaps, the value of their swaps increased and their counterparty owed them money, and the value of their bonds increased. But what happened this week was the opposite. And so this week, yields rose. So I noticed that in this chart pack, which is actually from BMO Management, they didn't give you an illustrative chart showing you what would happen when interest rates rose and this liability-driven investment scheme actually went into deficit. They only gave you the chart showing what would happen when interest rates fell, and it was good for the scheme. This week, it was bad for the scheme. So what would happen now is that the swaps here would read -10, and they would be demanding £10 in margin from the pension scheme, which meant the pension scheme needed to liquidate assets to provide the cash for the margin call. And the most liquid assets they've got are gilts. So what they did was they sold gilts. But the more they sold gilts, the more the price of gilts fell and yields rose, which meant their margin call got bigger and they were caught in a doom loop. And the Bank of England essentially had to intervene to break that doom loop by coming in as buyer of last resort. Now, as an aside, one of the big providers of these liability-driven investment schemes was BlackRock. And at the peak of this crisis on Wednesday, they were threatening to essentially close these schemes and liquidate them. So that would have protected them at the cost of the pension funds. But thankfully, the Bank of England intervened and that didn't happen. But it just goes to show the risks involved. If you have a counterparty like BlackRock, they will protect themselves before they protect you.
I think that's one of the interesting lessons of this, is it? I mean, the people say, oh, we have hedged our risk of X, Y, and Z, but they're entirely dependent upon the counterparty actually standing there when that hedge is required.
Yes.
And this assumption made throughout the industry that it's basically not correct.
Yeah. So this is as of this morning, and you'll see that gilts yields have repriced higher. So although the currency has recovered after the mini budget, gilt yields have not. And yields on index-linked gilts have also repriced higher. Now, what that means is, if you think about our earlier part of this presentation where I talk about how pension schemes attempt to match their assets with their liabilities, well, now they've got a positive yield on gilts again. So the attractiveness of LDI has suddenly collapsed. And so I was talking to a US fund manager yesterday, and he was saying he thinks that part of the sell-off in the US market yesterday was being driven by UK pension funds unwinding their LDI schemes. Now, what happens if those LDI schemes are unwound? And I should also say that these LDI schemes are absolutely enormous. The FT states that they're worth 1.5 trillion, or 2/3 of GDP, or the entire gilts market. So if only a fraction of them unwound, that means a lot of assets are moving around. So if you unwind an LDI, you're going to be selling the risk assets you hold. So that's bad for global equities and corporate bonds. And then you're going to be buying gilts, which is good for yields. And then if you're selling foreign equities and repatriating those assets to buy gilts, that is good for sterling. And so the comment of my US fund manager friend was that he thought part of the bounce in sterling over the last couple of days was that happening. So in summary, the mini budget has caused a big sell-off in gilts and volatility, and it triggered this doom loop in pension fund liability-driven investment schemes. But the thing is, the UK is very heavily financialized. And when you get these big ructions in financial markets, volatility, there are going to be big side effects. This case, it's in the gilts market and the Bank of England has stepped in. So bottom line is, the government should listen to advice and actually think about the side effects of its policy on the market. Richard.
Thanks, Keith. It's very interesting. I am going to defend the government in this case. You're absolutely right. I will defend the government only from the point of view of the financial system is so interwound, interlocked, and complex that nobody really understands the consequences of any particular event. And it comes back to your point, doesn't it? Of small changes are relatively uncontroversial. Big changes have all sorts of unintended consequences because everything is so complicated. And this was, they didn't intend it would be a big change. This wasn't their intention. They got that wrong. But because it was a big change, it has had and will continue to have nasty knock-on effects. And whilst I am fundamentally quite critical of central banks, it's entirely true that one of the roles of the Bank of England is to step in and stabilise markets when this sort of thing happens. And so that was completely the right thing to do. And Yeah, I mean, the whole thing is a massive misjudgment, but it does show that we have a very financialized world, and nobody really understands how it works in full, and it's impossible to predict the consequences of big moves.
Precisely. Well, I completely agree, Richard. But, some people understand it better than those two. They could have listened to the Bank of England, who told them, don't do anything daft because, you're going to upset international markets. That's all they needed to know.
Yeah, no, you're quite right. You're absolutely right, Keith. I completely take that point. You're quite right.
So this is the US stock market over the course of the last couple of weeks. And sterling has rallied over having sold off hard in the Far East on Monday morning. It's actually rallied back. It's actually up a bit further now. So it's a 111.5. So is that being caused by LDI flows back into the UK?
So we're going to talk a little bit now about the sterling crisis and the events of the last week or so, and also what we think the outlook for sterling might be. So we've been negative on sterling for a while, and of course one of the fundamental reasons for that was because of the energy crisis and the fact that we import so much of our energy. And Liz Truss promised to deliver unorthodox fiscal policy driven by tax cuts to fuel growth. We have her quote where we have had a consensus of the Treasury, of economists, of the Financial Times and other outlets peddling a particular type of economic policy for 20 years that hasn't delivered growth. The fall in sterling really is an inevitable consequence of what she has done over the last week or so.
Yes, we're just quickly blowing our own trumpet there, Richard. We've been forecasting a fall in sterling for months now.
Yes.
I hope regular viewers took the opportunity to diversify some assets out of sterling.
Yeah. So there we are, the headlines. And this is a sort of scatter chart of where the pound has been against the US dollar over the last 5 years. And suddenly we're a huge outlier, bottom right-hand corner. Big move. And as we know, sterling has had a historically bad day on Friday with a very large move, 10 percentage points.
But the important thing about this comment from Jens Nordvig is that we had a rise in bond yields at the same time as we had a sell-off in sterling. Now, that's not normally what you see in developed markets. Normally, a rise in yields supports the currency. And actually, we had sell-offs in both gilts and the currency. And that is a pattern you generally see in emerging markets, sadly.
And we see sterling here, at the bottom of its long-term range hasn't been this low since the Brexit vote. And what we don't want it to do is to break out of that range on the downward side. And as we know, it's bounced since the nadir on Monday. So our goods trade balance is looking very poor, and we have the energy crisis. We have a much higher cost of importing the energy that we need. I guess the only bright light on the horizon is the fact that if the pound is low, it makes our exports cheaper, makes us more competitive internationally. Mm. And here we have the charts that show what's happened to the cost of our energy imports since July 2020. And obviously, we have had a huge energy shock, as we talked about.
This chart shows, Richard, that in the last chart, we're having massive rise in the cost of fuel imports from outside the EU. The left-hand chart here shows that, but we're re-exporting about half of it to the EU. So when we talk about the investment position of the UK, this chart shows that there is a lot of portfolio investment into the UK, and that is all priced in sterling, whereas our overseas assets obviously priced in other currencies. And so we are in a very good position in that a fall in sterling actually improves our investment position because the value of our liabilities in sterling falls, whereas the value of our assets in foreign currencies remains the same.
As anyone who followed our advice to invest in either gold or, in my case, not so successfully, or US Treasuries in Keith's case, will know and will have found out over the last week. This is a chart that shows that the public sector debt outstanding UK is historically not especially high, although of course it was very high coming out of the two world wars, and it dropped from that point. As we referred to earlier, we don't actually have huge debt constraints. It's getting worse by international standards, but there is a point at which the indebtedness starts to cause problems in the international markets. We're very dependent on the international markets for purchasing our debt. And the other point, as Keith said earlier, is stability is crucial, and lack of stability frightens people off. So this is interesting, isn't it? The Institute of International Finance says our real effective exchange rate has hardly fallen.
Yeah. So against a basket of other currencies, sterling's actually tracked the vast majority of them down against the US dollar. Yeah. Actually, sterling's real exchange rate hasn't fallen very much.
So, as we've seen, it's recovered its precipitate drop from Friday and Monday. We have a big trade deficit. It's likely to widen further this winter with energy prices. We may see a boost in exports, but that tends to be a long-term effect, not immediate. And we need to be a manufacturing and an exporting nation for that to really kick in. We have instability. The mini budget is called instability and undermined international confidence. And we have QE. Risks are genuinely to the downside.
Yes. So I am remaining long US dollars. The thing is, Bank of England is doing QE again. And, we've seen what happens in Japan. QE just undermines the currency. So yes. Despite renewed QE, sterling is pretty much where it was pre-budget. I just don't think that's sustainable.
No, I agree.
And on to UK interest rates, and they have repriced higher. So massive jump in base rate expectations pre and post budget. And that is going to impact all UK borrowers. And these data is from the Spectator. I mean, that is a really sharp increase. And that has disrupted the mortgage market. So a lot of mortgage lenders have currently stepped back from the market because of so much uncertainty about their funding.
I think this will be a temporary effect. Yes. While they work out what's going on, and obviously while their counterparties in the fixed rate market determine how to hedge their own fixed rate positions and so forth. So I think we have a hiatus as opposed to a permanent disruption.
Completely. But if we look at the British Bankers Association mortgage rate, so the last data they had was for August. You'll see that this time last year, they're reporting mortgage rates of about 3.6%. So in August, it already risen to 4.9%. Now, mortgage rates should be linked to long-term gilt rates. And in August, UK gilt rates were averaging about 2.3%. They're now 4.2%. So if we add 1.9% to that,
you get 7%.
Yeah, you don't get happy outcomes.
Yeah.
And Richard's point earlier about how have continually kicked the can down the road and not allowed proper recession means that there are a lot of over-leveraged UK companies whose earnings don't cover their interest bill already before the rise in interest rates. Now, we look at Bank of England figures, total lending to individuals in the UK is 1.8 trillion pounds. Total loans to SMEs, 204 billion. Total loans to large businesses, 331 billion. Total aggregate credit, 2.3 trillion. Now, if interest rates rise in line with UK gilt yields, then UK faces an increased interest bill of around 44 billion pounds after the mini budget. And that means that whatever fiscally the government's given away is now going to be taken back in the form of higher interest bills, but the impact is going to be very asymmetric. It's going to fall entirely on borrowers. Now, the average mortgage in the UK is £138,000, and a 1.9% rise in mortgage rates equates to an extra £128 a month. So Pantheon Economics are saying that the average borrower refinancing a 2-year deal onto a new 6% mortgage will see their monthly repayments rise from £863 a month to £1,490. So much, much higher. That is going to cause real distress for a lot of homeowners. We have 600,000 fixed rate deals expiring in the second half of this year. So in summary, the rise in gilt yields will cause a rise in mortgage rates, and that is going to cause a great deal of financial distress to homeowners, borrowers, and corporates. Okay, and on to the UK housing market. Now, Richard, guess.
Oh, which one am I looking at? Actually, it's the black door or the blue door?
You're looking at the blue door. So this is a 3-bedroom terraced house in Highgate, which is quite an expensive part of London. Go on, how much?
1.3 million.
I should also say that this is the internal structure. It's got 1 bathroom upstairs. Actually, very much reminds me of my first house, which I bought for 200 grand in Archway. Anyway, 1.175.
I over-egged it, Keith.
Yeah, well.
£61,000 of stamp duty. I mean, it's disgraceful, isn't it?
Yeah, I know. This stamp duty is an idiotic tax. It just bums up the housing.
George Osborne.
Yeah.
I mean, sorry. There are certain words I mustn't say on this show because they trigger a reaction. One of them is George.
Yes. Yeah. You and me both, actually.
Yeah. And David, actually. His pal from Eton.
On Tuesday, if you try to get a mortgage on that house, a 90% mortgage, you could just about do it, actually. There's only one mortgage lender, Kent Reliance, offering a 6.2% fixed mortgage for 2 years, then going down to 5.7. But those are monthly interest bills of £7,000. I mean, who can afford that? But update as of last night, no mortgages available.
Am I right in thinking you have single-handedly been responsible for the 50% increase in mortgage applications this week?
Yes. Okay. So next one, Archway.
200,000, Keith.
You're looking at the house dead ahead. Ex-council, 3-bed.
750.
750. Again, really tiny. Kitchen at the top of the house. Looks all right. 675. Almost bang on, Richard.
I'm doing well at this. I should become an estate agent.
Okay, so this time there are more options available. £3,000 a month for 24 months at 2.65%, but then is going to go to 5.1%. And we look at that in more detail. So we've got a load of fees. 5.5% equals £3,700 a month from post-tax income. I mean, who can afford that?
No one can. I mean, well, people can, but the property market is going to drop, isn't it? Significantly, it has to. There is no option. I mean, the thing that will hold it up a bit is the shortage of housing.
Yeah.
But the average price is going to drop.
Absolutely. So the problem is, in the last 25 years, UK house prices have gone up fivefold, and are just now, that was a function of very low interest rates. Now interest rates have shot through the moon. They're going to have to fall again. Simple as that.
Well, this is where we have the canard of inflation numbers, isn't it? Which haven't included asset prices.
Yes.
And in fact, by not including asset prices, it's perpetuated a vicious cycle of increasing asset prices.
Yeah, no, that's true. So the investment implications are that the housing cycle has to slow, and that, as we've covered many times, the housing cycle is the business cycle, and that will drive the UK into a deeper recession. So avoid house builders, building merchants, builder suppliers, etc., etc.
Yeah. So moving on to our weekly checklists. It's quite a volatile week in stock markets, so volatile in a downward direction. So all actually down for the week by around about between 2.8% and, in the case of the topics, 4.2%. So a significant down week for the major global stock markets. Little bit of a bounce of Bitcoin. And we've discussed the pound against the dollar, although ironically, after all of the big moves that we have seen of late, the net movement is 0.3%. And the euro is up 0.4% against the dollar, but look how far down they both are for the year to date, and the dollar index up 17% year to date. And this is the FTSE, which has gone nowhere now for roughly 25 years, I think, isn't it, Keith? One looks at the long-term chart.
Right. It certainly had a bad week.
Yeah. The S&P 500 retesting its June low. I think it's going to fall further than there. The NASDAQ composite, long-term chart of the NASDAQ is interesting, and we'll look at one of those later. And Keith will explain this chart.
Okay, so this shows the annual performance of the S&P 500 for every year for the last 96 years. And the dark blue line is the current year. So, you know, it's
a relatively poor year.
It's having a bad year.
And drawdown. So it's surprising, isn't it, actually, that drawdowns are a little bit like boiling a frog alive. You know, it's a little bit here, a little bit there, and you suddenly take a step back and you think, goodness me, the S&P is down 24% from its 4th of January high.
Yeah.
It's a large drawdown, approaching the average drawdown. And I don't think it has stopped yet by any means.
Nope. Now, during the week, actually, I did a short podcast on the Kalecki-Levy formula and why a falling US deficit this year must mean a fall in US corporate earnings, which is not priced in. So this coming earnings season, expect to see a lot of earnings misses and profits warnings, and that must drive the market lower, in my opinion.
So you see record put, this is really record put buying, isn't it? It's extraordinary, which suggests that the market's due for a bounce, I would think.
Yeah.
Much of it on single name stocks, as opposed to indices.
Yeah, no, that's been a big change in the last few years. The growth of, GameStop and the Reddit crowd.
Interesting. And the dollar is in a bull market at the moment, but it potentially has a long way further to go. Yeah.
Historically, it's been much higher.
Yeah. And the sideline says it all. US earnings forecasts seem delusional.
Okay, thank you, Richard. On to commodities. And first of all, I thought this was a corking chart. This is the grey mush at the bottom is the percentage of world energy consumption that is fossil fuels. That red bar at the top, the red wedge, is renewables. Essentially, the energy transition is very slow, and we are going to remain dependent on fossil fuels for a very long time, but we've stopped investing in them.
Keith says we've stopped investing in them. What he really means is I will be buying back into them in due course.
Yes. Good stuff, Richard. Okay. So it was generally a poor week for oil, down. Brent was down 1.1%. After the explosions in Nord Stream, Dutch natural gas futures rose 9% this week and up 186% this year. UK natural gas futures actually fell, down 11% this week, only up 50% on the year. Good for the UK. US natural gas futures also fell by 5%, although up 85% on the year. Coal was flat, up 157% on the year. Uranium drifted off slightly. Onto some numbers specific to the oil market. Well, very interesting. Last week, we talked about how inventories were building in the US and the US oil market seemed to be well supplied. Well, this week, completely reversed. Total US oil inventories fell by 13.5 million barrels. That's an enormous fall, and suggests actually the US is not well supplied and oil prices will have to rise if that continues. So even after releases from the SPR, private sector inventories in the US fell by almost 8 million barrels. These are big drawdowns in inventories. US total crude production fell to 12 million barrels. It's only up 200,000 barrels a day on the year. Not good, but the rig count ticked up 3. Okay, so this is Brent drifting off as fears of recession cause traders to dump oil. And this is a really interesting chart. So the bright yellow is the annual change in US oil production. The light yellow is the rest of the world. And essentially, the shale revolution caused the price of oil to drop, and the rest of the world essentially stopped investing. And now the shale oil revolution appears to be stalling. I think the oil market is going to be tight for years to come. And this is US oil inventories, which have resumed their slide. EU natural gas futures down from their highs, but just had the Nord Stream blow up, and it's getting cold in Europe. This is the UK. Now, these are UK gas imports by origin. You'll see we get most of our gas that we import from Norway via pipeline, but had big increases in LNG, particularly from the US. This is European LNG imports. And actually, not the biggest importer. Spain and France import more than us. This chart is from Total. And if you look at the right-hand one, they're forecasting global LNG to be in very substantial deficit for the next 5 years. That implies high prices. This is US natural gas futures, drifted off. Of course, when the Freeport LNG facility comes back online in Q4, then hopefully demand will increase, prices will rise in the US, but we will have more LNG supply in the market. This is coal, which seems to have reached the permanently high plateau. Uranium flat. Richard.
Thank you, Keith. So industrial commodities, relatively quiet week, actually, looking down this chart. Not much movement in the aluminium, cobalt, copper, chromium, iron ore, or lithium, or neodymium, actually. Nickel dropped 9%. Nickel is extraordinarily volatile on a daily basis, I would say. Tin down 3%, zinc down 5%. Year to date, a lot of commodity prices are down around the order of 20%. So a reversal of the bull market we saw this time last year. Tin has almost halved. Lithium, as we know, has almost doubled. And the question, I think, is if you're interested in investing in industrial commodities, is the world actually heading into a recession, and therefore will there be a surplus of supply over demand? Or has the time come to reinvest in these because of production has declined as a result of increased energy prices? And if you are going to invest in them, how are you going to do it? Because if production costs have gone up in line with energy prices, then profitability of producers may not have changed very much. And therefore, should you actually invest in the commodity itself?
Yeah, good question. I think it's way too early to consider investing in these. But you raise a very good point going forwards, Richard, because we are forecasting that energy prices will remain high. And miners are very intensive users of energy. And so you need the underlying commodity price to rise much more for them to return to a decent level of profitability.
Exactly so, Keith. And I agree with you about the cycle, where we are in the cycle. It's too early, much too early to know where it's going to go. So we have aluminium, cobalt, copper, chromium, iron ore, lithium, neodymium, nickel, tin. Whoa, it's really come off, hasn't it?
Yeah, no, I put in the long-term chart of tin because it just shows you how sharp that extraordinary bull market in tin was that peaked in March.
Ferrovanadium and zinc. So moving on to precious metals. A very quiet week for gold, down 8.5% year to date in US dollars, note, not in other currencies. Silver down 2.6% and 18% for the year. Platinum down 2%, 10% for the year. Rhodium almost unmoved, and palladium up 2.4% and 16% for the year. There's gold priced in US dollars. Central bank gold purchases. Interesting that central bank gold purchases have increased substantially over the past couple of years.
Yes, Richard. Back to your point that central banks realize that holding each other's paper currency may not be such a great idea.
Yes. And they're better selling it and buying gold. And there's the price of silver, which had a bad year. Platinum, it's also had a bad year. And rhodium, which has had a bad year. And there's palladium.
Okay, thank you, Richard. On to rates. Well, an absolutely extraordinary week, as we have discussed. So UK 2-year closes the week up 70 basis points, 5-year up 74. What's really interesting is the 50-year is actually down after the Bank of England intervention. You'll see how much of difference there is between the 20-year and the 50-year. That looks unsustainable. The 50-year should be trading much closer to the 20-year. And on to the Eurozone periphery, where this week there was a sell-off in both Greek and Italian bond yields. So the Greek yield has now hit 4.86%, and the Italian is up to 4.55% after Italy elected Giorgia Meloni from the right-wing Brothers of Italy party as the new prime minister. Now, in the US, inflation expectations appear to have peaked, although you'll know that US bond yields don't appear to have peaked. So What is driving US yields higher if it's not inflation? Now, this is the Italian bond spread to bunds, which is rising and is in the zone where the ECB would normally react, but it has not done so. This is UK 2-year, which is up enormously from a few months ago. 10-year, although the Bank of England has intervened at the long end of the gilt market and the currency has recovered, bond yields are not coming down to anywhere near the same extent. This is the UK 30-year, which has come down a long way from those extraordinary highs driven by pension fund liquidation. This is the 50-year, where the pattern is even more extreme. This is US 10-year, and you notice how similar this little peak is to the UK. The markets are saying there's been general contagion. This is German bond yield, 10-year. So this is Italian bond yield. And this is the Greek. Reminder that Greek bonds are mainly held by institutions, so Greece is not really exposed to market rates. And we are heading into a very difficult period for the market traditionally. And concluding comments. Well, last week we warned you to batten down the hatches, and we were absolutely right. Well, this week, I don't think it's got any better. Richard?
Buy beans and guns. Can't buy guns in this country, Keith.
Yes.
Going to buy baked beans soon, actually.
Yeah. What have you been up to this week?
So, thank you, Keith. I like to look at my relative performance rather than my absolute performance. And I have avoided the downfall of the FTSE all share. My change for the year is a paltry 1.4%. And the shenanigans of the pound over the past few weeks have basically, I've been insulated against by my ownership of gold. And my investment distribution hasn't changed terribly much. I realized I should, so how have I bought the gold? I've bought the Wisdom Tree Physical Gold Trust. So what they have is allocated physical gold in bank vaults. So they don't purchase gold via instruments, derivative instruments, they actually own the gold. And I think that's very important. So the Wisdom Tree Physical Gold Trust, and I have recently purchased Encore Energy, Sky Harbor, and Geiger Counter Investment Trust as my uranium investments, which I am back in. And I think I might have mentioned that 2 weeks ago. No sales. My uranium is a small proportion of the portfolio. So this is my distribution of portfolio balance. And so that's a Wisdom Tree Physical Gold Trust. This is the GBP version, and you can see it's almost at the top of its, almost at its, when it's around about its highs. It needs to go up a little bit, 7% increase, 7% off its highs, I think. It's an interesting shaped chart, actually, which potentially augurs that there might be a breakout coming in gold priced in British pounds, but we don't know. We'll have to wait and see. And for me, it's an insurance policy. I want to just mention diversified energy, which both Keith and I hold, and it's certainly my only energy company holding. And it's right at the very top of the range that it's been in for 3 to 4 years now. Which is interesting. It's a natural gas producer, hedged production, so it hedges its the price it will get for its gas going forward, and it yields around about, I think, 10%, isn't it, Keith, roughly speaking?
Yeah, more than that, 12 actually, 12%, I think.
So I thought this was an interesting chart, which suggests that it may fall back down to the bottom of its range, but if it breaks out of that range, it suggests that it may have further to go. And then this is a long-term chart for US tech and NASDAQ 100. And where's that chart going to go is my question. And yeah, it's going to I just got to do this, isn't it? In my view, there's a high chance that it will basically repeat this pattern down here, which means it's got another 60% or so to fall. I wouldn't be the least bit surprised if that happens. And I think there will be a time to reinvest in the stock market generally. I personally don't think it's now. What have you been up to this week, Keith?
Well, I completely agree with you on the NASDAQ, Richard. I think it's got a lot further to fall. Okay, my portfolio, well, I had an amazingly volatile week. Regular viewers will know that 3 months ago, I moved all my assets out of sterling into US dollars because I didn't trust Liz Truss. And I've been absolutely right. So at one stage during the week, I was up over 4%.
Wow.
But sterling has rallied, and as of this morning, I'm up only 0.4% on the week, but that's obviously much better than the all shares doing, and I'm having a good year. So I had no buys, no sells. This is my asset allocation. It's mainly in US short-term bonds, with the vast majority of the remainder in US long-term bonds, and that is not a trade, frankly, that has worked out yet. So this is my main holding. It's the US 1 to 3 year Treasury bond ETF. That should read IBTS, and it's come off, having spiked higher early in the week, it's come off a bit. And this is the 20-year plus, which I've got wrong. Essentially, it should, so despite the rise in sterling, the falls in the underlying have offset that, and it hasn't worked. And that is too much of my portfolio. I've been too early and impatient, and that costs you money. And this is the reason why I have been losing money. This is the price of a 30-year US Treasury bond, and you'll see it's just trended relentlessly lower, sadly. Okay, very long one this week. Lots of ructions in the market. Thank you for watching through to the end. And thank you for Richard for getting off his sick bed to
Thank you, Keith.
come and work on Portfolio Matters. So
it's good to be back.
Great. It's great to have you back, mate. So please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.